Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 15th of September. I'm Daniel Lam, your host for the podcast. This week, all eyes will be on the FOMC meeting, which is early Thursday morning East Asian hours. Now, last Thursday's US CPI was the final key macro data point. It was in line with expectations. It remained unchanged at 3.1% year over year in August, which is well above the Fed's 2% target, but is still reasonably contained, and there's still limited impact from tariffs. This, combined with the weak series of US jobs reports, which we discussed at length in last Monday's podcast, means the market is fully pricing in a 25 basis point rate cut in the upcoming FOMC meeting. So now the key question is, how much and how fast the Fed will be cutting rates? Now in our base case, we see the Fed cutting by 25 basis points this week and 50 basis points more by year end as the US job market slows. Now Fed rate cuts and a robust outlook for AI-driven technology sector earnings should help partially offset a growth slowdown and seasonal weaknesses in the coming weeks. Asia ex-Japan equities and EM local currency bonds should benefit the most in this scenario as the US dollar weakens marginally. We would be adding 5 to 7 year maturity US government bonds if the US 10-year government bond yield rises above 4.25%. What are the other scenarios? Well, a hawkish 50 basis point Fed rate cut could have the same effect on risky assets as our base case, especially if inflation remains restrained. Now, meanwhile, a hawkish 25 basis point cut could lead to a short-term pullback in risky assets and a bounce in the US dollar. Finally, there is a low probability of a dovish 50 basis point cut, given markets are not expecting that, and Chairman Powell has never surprised markets. However, in this event, long bond yields could rise and the US dollar could fall due to concerns about the Fed's independence, ultimately hurting risky assets. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.